Hello, I'm Jay Hirsch, Director of Administration of Columbia's ERM program. I'd like to welcome you to tonight's event, Navigating Non-Financial Risks in Multilateral Development Banks. Throughout the event, you may post your questions, but the questions will be answered at the end of the event. Here are some upcoming events. On Fridays and Saturdays, we run all of our ERM web seminars. On March 4th, we have our geopolitical risk panel. And on April 4th, we have our managing conduct in a digital world panel. So please be sure to register for those. And now I'd like to introduce tonight's moderator, Bob Kostakopoulos.
Thank you, Jay. Welcome, everyone. My name is Bob Kostakopoulos. I'm Deputy Program Director and Lecturer in the program. I have been with the program since 2016. I have our panelists here introduce themselves, and then I will say something, and then we'll start our questions.
So thank you. Thank you to Columbia University ERM program for inviting us to come and talk a little bit about multilateral development banks. So my name is Kerry Lawley, and for the last 8 or 9 years, I've been the Chief Compliance Officer of IFC, which stands for International Finance Corporation, and it's the private sector investment arm of the World Bank Group. And my responsibilities include ERM, Enterprise Risk Management, in a number of areas that are very relevant today. We're going to kind of skew the discussion around some non-financial risks, where we have to think very carefully about ERM. So these are risks like business integrity, know your customer, money laundering and terror financing risk, economic sanctions risk, those sorts of risks. I'm a lawyer by training, and I've been in the World Bank Group for a number of years, 16 years, and I've had a great career doing a range of different things that we can talk about at the end if anybody's interested. And I have degrees from Oxford and Cambridge universities in the UK and Georgetown University Law Center in the US. It's great to be here.
Good afternoon, everyone. My name is Andy Xu, and I'm an Associate Compliance Officer at IFC. I've been with IFC for 6 years and working on anti-money laundering issues as well as different technology initiatives that supports our compliance and risk management program. I attended the ERM program many years ago. I was part of the program between 2017 to 2018. I attended Bob's class in traditional risk management, and also I serve as a teaching associate for Bob's class in company failure in 2019. So it's very pleasant to be back to the ERM community, and I'll try to make this conversation more relevant to some of the curriculum and program stuff that many of you may have learned. And again, thank you for the opportunity for the program to having us.
You know, I have a special place in my heart for organizations like IFC, because they're part of the nexus of institutions that since 1944, those institutions have been put in place that have resulted in GDP, global GDP, growing to $100 trillion a year. Global trade volume growing at higher rates than the GDP rate throughout this period of time. Those institutions, of course, are the World Bank, IMF, the World Trade Organization. If they're going to have free trade, some countries are going to get in trouble. The IMF is there to help them. That's mindful. So it's a different system. It has lifted millions upon millions of poor people out of poverty and into the middle class. China alone, 750 million people. So it's a And IFC continues to on that mission. And that's so having said all that, we are ready to dive in because we would like to know what exactly is a multinational lateral development bank.
Thank you. And it's a great first question. And I think it's an important first question. And I think lots of people in the room will know what a private company is and a public company, and they'll have a sense of what an NGO is and a nonprofit. Not so many people know what a multilateral development bank or an MDB is. And I think the key thing about them, the foundational piece, is that they are set up under an international treaty signed by more than one country, member country. So the foundation of everything they do is that international treaty. And in the case of the World Bank, the treaty is signed by 189 countries, IFC the same. A lot of MDBs are much smaller, and some are just maybe have sort of 6 or 7 signatory countries. But the key point is that international treaty is at the foundation. And to my mind, there are 3 things that flow from that, which are central to what we do. And the first one is that the treaty sets out a kind of mission and a mandate for the Multilateral Development Bank. And in the case of the World Bank, as you say, it was set up after the Second World War to build a ravaged Europe and to re-stabilize the financial system. And as the years have gone on, its mission has changed. It's still there to relieve poverty, but its focus has been emerging markets. And now its focus is the really challenged emerging markets, places where private sector money might not want to go, and places where private equity managers are less interested in going. So some of the really fragile, conflict-affected countries, which is not to say we're not also in the middle income emerging markets. But the mission has migrated as time has gone on. And IFC, where we come from, has a similar mission to relieve poverty, but with a private sector focus. It does it by investing in private sector companies in these emerging markets. So that's number one. There's got to be a mission and a mandate. And number 2 flows from the fact that we're owned by nearly all the countries of the world, 189 countries. And each country has a governor, usually the Minister of Finance, or it could be the head of Treasury, that is ultimately responsible for setting the strategy and direction, as a group of governors. So government is dictating and setting strategy and direction. That would be number 2. And number 3 is that we have these things called privileges and immunities because we're set up under international treaty. And this is where all the countries agree that we're not going to be subject to any one particular jurisdiction. So to give the illustration of the 3 main immunities, we're not subject to any particular regulatory oversight. And the idea being that if we were, well, which of the 189 countries would it be? And we also, for the direct work that we do, we're not directly subject to tax. We're tax immune. And again, it's because if we were to be paying taxes, where would we be paying them and which country would prevail? And then third, we also have immunities around our record keeping. So this will play into this discussion about ERM. So when we're choosing which framework to follow, we don't follow a particular country, nor do we follow a particular region. We're looking to take what we think is the best of all of them to allow us to fulfill our mandate. And we'll come back to that shortly. But Andy, I think you were going to talk a bit more about the MDBs that are out there.
Yes, and I understand we will come to this career discussion at a later part of this panel. But when I first started looking for career opportunities in the MDB community, there are 3 questions that comes to my mind. The first one being, what business do MDB do? And then secondly, in order for MDBs to do all this business, where does the money come from? Where's the source of funding? And then thirdly is, what are the usual players in the market? So to the first question, what business do MDB do? It's actually quite simple. It's everything that you could think of that fulfills a sustainability criteria. So it could be providing funding in an infrastructure project. It could be a project in healthcare, education, all of these sectors that could promote the economic growth in developing countries. And in order to provide all these financing or funding support to all these projects, the channel is also rather simple if we kind of overgeneralize it. It's basically through either grants or low interest loans, and we'll come back to these low interest loans point in a minute, because it's somewhat correlated, is somewhat related to the source of funding of MDBs. And then in terms of other projects, the product that MDB provides, if you go online, go to organizations like World Bank, Asian Development Bank, you will see a lot of terms like technical assistance, capacity building, policy advisory. So all of these would be these think tank or NGO type of product would be some service provided by MDBs or some subunits provided within an MDB to provide. But I would say I would say most part of the MDB services provided is really through grants and low interest loans. And here comes to the second question of where does this funding or source of funding that MDB use to conduct investment development projects. And many people would simply think that MDB just take contributions from their donor countries, their funding countries, and then they directly disperse the funds. I think a smaller portion of the project was conducted in that way through some direct donor funding, and that donor funding was administrated by the MDBs. But actually MDBs, but that amount of money actually composes a smaller portion of all the capitals that MDBs managed and dispersed. And actually it's a smaller amount as many people may think. Just to give an example, and this is publicly available data online, for the World Bank itself, it has 22 billion paid in capital, which are capital coming from the donor, contribution coming from its member countries. But the actual capital, but this is only less than 10% of the overall money that are managed by the World Bank. And actually World Bank, organizations like World Bank, MDBs, would go into the international markets to issue bonds and raise funds through the international capital market. And through that mechanism, these MDBs will be able to manage their liquidity properly and to maintain their AAA rating. So with that, they will be able to go to the international market to raise funds with a relatively lower cost of financing. And then that would enable them to issue the actual low interest rate funds to its counterparts, to the developing countries. And with that, this will also bring in some profit for these MDBs, and all of this profit and revenue generated by the interest difference that I just mentioned will again go into the source of funding that is used to conduct further development projects. So this kind of answered the second question I had on the source of funding. And then thirdly, on the major players, and we can come back to this in details when it comes to the Korea discussion. Obviously, there are a few reputable MDBs like the World Bank, but there are several other players which are kind of regional focused. For example, in Asia, we have Asian Development Bank, which is a major MDB with Asian focused. And it's also worth mentioning that for all these MDBs, they only hire nationals from their member countries. So just to give you an example, Asian Development Bank has 69 member countries. So only person with these 69 nationalities will be able to work in the Asian Development Bank, and it's based in Manila, Philippines. And we also have African Development Bank based on Abidjan, Inter-American Development Bank with IDB, which is also headquartered in Washington, DC, with whom we interact a lot in DC, and European Development Bank, European Bank for Reconstruction and Development, or EBRD in short. It's headquartered in London, UK, but we also had a lot of interactions, especially in the compliance and risk management space. There's also one development bank that is MDB that is developing, kind of growing quite rapidly these days, is the Asian Infrastructure Investment Bank, AIIB, which is based in Beijing, China. And there's a few other smaller players, such as the Islamic Development Bank. There's a Caribbean Development Bank. And I also wanted to mention there's a New Development Bank. That's the name of the organization. It's called New Development Bank. It's established by the BRICS countries, namely Russia, Brazil, India, China, and China. And it's headquartered in Shanghai, China. So we'll come back to these organizations and some of the opportunities there in a moment, but over to you, Bob.
Can you summarize the technology of those typical investments?
Yeah, so going back to IFC, so we've set the scene as to what these MDBs are about. Looking in particular at IFC. So IFC is, as we've said, private sector investment arm of the World Bank Group. And it's about 5,500 people. We're located in over 100 places in the globe, around the globe. And interestingly, a lot of our offices are not in the obvious places in all the European capitals, for example. Our offices are where we are doing the deals. So we have over 30 offices in Africa. And we've got many offices in other emerging markets around the world. As Andy said, we've got this AAA rating, credit rating, which is absolutely central to everything we do. And we have it because we are owned by 189 countries of the world. So we're supported by them. And as a result, we have this AAA rating, and we can borrow cheaply. We add a spread to cover our costs, and then we can lend out inexpensively. That's the kind of model. And last year, we invested about 50 billion during the year, and we're on track. We're going through a bit of a growth spurt. So we're on track to invest about 60 billion this year, just over 60 billion across all these sectors that Andy has described. And you, Andy, we're going to give a few examples of typologies of deals that we are engaged in. And these are not specific, they're typologies, just to be clear.
Sure. Coming to the exact product that IFC offer, basically there are three types of product. One is what we call investments product. The other one is advisory product, namely providing some policy advisories to the local government or to some of the private sector players in the market. And then the thirdly is a very smaller portion where we mobilize private source of funds and it's more on the asset management aspect. So coming back to the investment pillar, I think just to oversimplify it, it's basically for all these investment product offered by IFCs either through loan or equity. And by saying loans, IFC would be engaging with our client who has financing need, and we would provide the loans with certain terms. And there's also a smaller portion of client engagement where we would become the shareholder of the company, and this is quite common in the VC and technology space, as well as some healthcare investment where IFC would go in to become the equity shareholder of the company, and then to also provide some type of advisory services to the client to help the company grow. And typically IFC would exit that equity investment when the company becomes kind of financially mature and has the relevant, financing capability. And very often these exit take place before IPO. So IFC would not kind of envision itself to trade a lot of listed stocks, especially when it comes to these equity investments. And on the examples, obviously as a Chinese national, I'm quite pleasant to see how IFC participates China's economic growth. And for those who are familiar with the Chinese financial market in China, IFC is one of the initial investor of Bank of Shanghai, and it's also one of the first foreign investors in a few commercial banks in China, namely Minsheng Bank, Industry Bank, Bank of Nanjing. I mean, all of these become relatively big bank these days in China. Just to give everybody, and we also prepared a few typologies of a few hypothetical investment projects. And just to give everyone an example, it could be an agriculture business in West Africa. that are looking forward to expand its business. And IFC would again come in to become a minority investor to provide loans. And together with IFC, this investment from IFC would become kind of like an endorsement of the investors' confidence of this company. So with that, IFC might be able to bring in a few other major banks, let's say from France, to also join IFC as part of that investment. And another example would be a well-established Turkish bank who are looking forward to expand their operation cross-border. IFC may not participate in these kind of deals, but if there's any additionalities, for example, if this expansion would be more targeted on helping the SMEs, the small and medium enterprise, or helping with financing with some blue or green theme. I mean, with this type of additionality, IFC would also be actively engaged.
You mentioned that IFC invested in the Bank of Shanghai and all that. Do they still have a equity stake there, or?
I think for that particular project is.
How long do you keep your equity investment in the project?
I think very often these exits, if this is an equity investment, very often it would take the exit will take place once the company has sufficient financing capability. So I don't think we'll have an equity position there. And very often this investment is through loans. So once the loans matures, IFC may pull out. But from what I know, just to give using Bank of Nanjing as an example, I think we still have active engagement with some of the subsidiaries there to support, for example, in the financial leasing sectors, as well as some SME lending, microfinancing activities there to have an active engagement there.
I must say, when we take an equity stake, it usually is a pretty long-term commitment, and these are often not very liquid markets. We like them because you can really have development impact in these. If you are a shareholder, you can do so much more. We always like then to have some directors on the board, at least one director on the board. We would usually like to provide technical capacity building, and we would really like that company to engage, try to build out their processes and controls. They can be our really strong success stories, but then the exits are quite difficult. And as Andy said, IPO, perfect if there is an IPO opportunity. Very often they're just trade sales. These markets are quite challenging. But we're a long-term investor, and we also take a long time to decide who we want to do business with. So every year we would do about 300, 350 deals. That's not a lot of deals. We're certainly not in the retail space, but we really want to get comfortable that we're working with sponsors who are like-minded, that want to do things properly. They might still have a journey to go, but they've got to be like-minded and commit to our quite onerous due diligence processes to build out their controls.
So you're looking for impact as opposed to
Absolutely.
deals.
Absolutely. Mm.
Now, you talk about governance, right? All of your board of directors are from the equity holders, 189 countries, right? How does that system work?
Yeah, well, it's a bit unique. So we do have, I mentioned at the outset that we have this board of governors at the top, if you like, and they would typically be the ministers of finance or heads of treasury in our 189 countries. And then they would delegate to somebody that's got a bit more time than they have to sit on our board of executive directors. And that's the board that really is the group that would develop the strategy and the direction. Now, you can't have 189 directors on a board. So the way we organize the world or our membership is that we've divided them into 25 constituencies, and each one has a director. And the constituencies are usually geographic. So there'd be countries in a particular geography that are grouped together, and then they have one person that they designate to be their spokesperson. And they have to reach consensus actually in the direction that they're going to give between that grouping. There's an exception to this insofar as the 6 largest shareholders that have their own position on the board. So the US is the largest, Japan comes next, It's got its own director, then China, then Germany, and then Britain and France. So those 6 have their own director, but all the rest, yeah, China, I suppose that's right. You could describe it like that, but they're not grouped up with other countries. They have an executive director position for each of those countries, and then the other countries of the world are grouped into these constituencies. So they're setting direction and strategy, pretty unusual. And then we have a senior management group. And the senior management group, the glue between the senior management group and the board is our president, who is presently Ajay Banga, who is a US citizen of Indian descent. He's very high profile. He's come to us from MasterCard. He's pretty charismatic and a real businessman. And we don't often have a president of the World Bank Group who's a businessman. Very often they're more development or public service backgrounds. But he's very much a businessman by background. He is the glue, if you like. And then our senior management is the one that develops our ERM framework, approves it, and risk appetite, and has a series of committees. And I'll just mention 2 that are relevant to this discussion about ERM. There is a committee, a risk committee, that would be the committee that would approve the ERM and framework and risk appetite. And then there's another committee that approves the really difficult investments that are escalated to it. So there's a small number of deals that are so sort of sensitive for one reason or another, that would go to this senior management group as well. So it's a pretty unusual structure, as you'd expect for an organization like ours.
But it's functional.
It is functional, yes. You know, when you've got to corral the whole world, I think we're doing a pretty good job.
I just want to mention for these boards that Carrie just mentioned, these executive directors, these are full-time board members. So it's really so even though they're delegations from certain countries' Ministry of Finance, they serve as a full-time board member at IFC and at the World Bank as well. And they would convene on board meetings. And I know in our ERM curriculum, we speak a lot about direct access and direct report to the board. And Carrie and I, we've been to the board a few times with the board audit committee. And really, these people would be involved in some of the more substantive non-financial risk discussions. And they review quarterly reports that were submitted, prepared by our units within IFC, but also other risk management functions. And they do get informed. And sometimes they could go quite in-depth into certain technical questions. And with that, it would require some technical briefing from an expert, from a risk expert from our unit.
Now, can you speak a little bit about the functions involved in processing an investment, just the nuts and bolts, briefly?
Sure.
That's definitely you.
Sure.
It's your day-to-day job.
Yes. And I think the first question when it comes to processing an investment is always the question of where does all these deals come from? So when it comes to deal origination, this was done by the regional teams. As Carrie mentioned, we have over 100 offices in the different markets, and we do have investment officers based in those markets, and they would actively source for good deals. I mean, some deals would be referred to IFC by referral by some industry association or through some networking channels, or these could be deals from a client that we worked with in the past, and now they have different financing needs, or they have a good project, which it also completely makes sense for IFC to be involved. So it's all by way of saying the deal origination takes place more at the regional level. But when it comes to kind of processing a deal internally, a lot of HQ headquarter colleagues will be involved because there are many stakeholders involved in these in a single deals. The investment officers that I just mentioned, they will be more on the driver's seats to drive the deal, but then they need consultations and technical support from all these supporting units. For example, on the environmental and social impact of the deal, that would require an ENS specialist advice. If the deal has substantive, integrity issues, our colleagues from the integrity unit will need to opine. Project lawyers will be involved. There are industry specialists who have years of experience kind of working in a particular sector and knows a particular sector so well in the market. That person will also need to be involved. There's credit colleagues involved, assessing the credit worthiness of the client. And did I miss anything? Yes, there are corporate governance specialists that needs to be involved as well. So all of these stakeholders will be involved throughout this internal process, and we take it by phases, namely starting with conceptualizing the investment idea by formally documenting everything in what we call a PDS concept note. And these will be somewhat circulated among all these stakeholders that I just mentioned. And once the project materializes, the next stage will be what we call appraisal, meaning that our investment officers, together with a few key stakeholders that needs to be involved in the project, they will actually go on site to visit the clients, to ask the relevant questions to the senior management. And for my purpose, working as an AML specialist, we do have interview with the chief compliance officer from those clients' company, just to understand those financial institutions' practice in anti-money laundering efforts. And then it comes to, after approval, all these investment deals will go to an investment committee internally, what we call IRM, investment review meeting, to decide whether this project is a go or no go. And after that, it follows the subsequent internal escalation and approval process. Namely, the project needs to be reviewed by the senior management of IFC, and if it meets certain threshold, this will also go to the board for board approval. And when it comes to finalizing the deal with the clients, there are two major documents that finalizes this engagement with the client. One is what we call a mandate letter, meaning that IFC will confirm with the client that you have interest to pursue this engagement. And then once the project progress, everything will be finalized in the investment. For example, if this is a loan, it will be documented in a loan agreement, specifying all the terms. If this is an equity investment, it will be documented in the shareholder agreement. So in a nutshell, a lot of stakeholders involved being consulted, all the risks being thoroughly reviewed and discussed throughout.
Well, it leads into the ERM framework, actually, that we have. Maybe we shift into that. So the ERM framework that we have, just to repeat three of the big themes that come through, and I hope they've come through already, but our ERM framework is built on, first of all, our mission and mandate, this whole thing of relief of poverty. Our development mission cannot be compromised in our ERM framework. So it means that we've got to have people around the globe sort of thinking about relief of poverty and really understanding what's going on in markets. But we've also got to remain financially sustainable, because our credit rating, AAA credit rating, is absolutely central. And then the third principle is safeguarding our reputation. So our reputation is I always like to say, it's our brand. We have to really think about our reputation, particularly in these areas that we're going to come on to of, fraud and corruption and money laundering and terror financing. We can't compromise. So they are the three foundational principles. And so we needed to design a framework that gave recognition to the three of them. And we looked at ISO 31000, and we looked at COSO ERM frameworks, and we've drawn pieces from them. But because of the challenging mandate that we have, we've got to kind of develop something a little bit for ourselves. And the thing that we've focused on most in our ERM framework is not ISO or COSO, but the 3 lines model, the Institute of Auditors 3 lines model. And Andy can sort of explain what it is, but in that first line, and I'm sure you will have thought about the 3 lines model and discussed it already in other sessions, but the 3 lines model has at the foundation, the first line, the people who are doing the deals, the investment teams, and that's where most of our people are. So they're out of our 5,500 people, about 3,000 are people doing the deals scattered around the globe. And then there are support functions that we'll come on to. But in answer to your question, Bob, the people, most of the work on these deals is done by the people in the field doing the due diligence and really the appraisal and really putting this deal together. And it's project finance at the end of the day. These are very complicated deals that take a long time to construct and give effect to. But I know you were going to explain a little bit about the way we think about the 3 lines model.
Yes, so we speak about lines of defense a lot in the ERM curriculum. So in IFC's context, these looks more in a way, the first line being the frontline business, that's by definition. And in IFC's context, is pretty much the investment officer, the investment teams that are at the regional hubs doing these deal sourcing, and they were at the driver's seat trying to push a deal through the internal process. And in essence, they own the risk. So they take the responsibility to make the actual decision whether this project will be go or no go given the risk level. And our second line that composes almost every supporting function that involves the risk subject matter areas. Just to give you an example, for our purposes, we are a risk and compliance unit. So when we would be consolidated as a second line of defense, a second line function when it comes to integrity risk and money laundering risk, conflict of interest issue. And there will be a second line function like the environmental social team when it comes to an ENS related risk. That's team will needs to be consolidated. And all of these second line functions, they in essence provide advice to the first line, and it's ultimately the first line's decision, and they're following their internal escalation process to decide whether the risk, the project should go forward or not, given the risk level. And the second line functions like us, like ENS, like our credit risk functions. All of these units will support the front line by providing them the relevant guidance, trainings, and we also consolidate reporting on a quarterly basis to report to senior management and the board, like the audit committee meeting that Carrie and I attend regularly. And when it comes to the third line, IFC, it's not at the IFC level, but at the World Bank level, we do have an internal audit function. It's called a GIA, and they regularly conduct internal audits, not only on the financial aspect, but also on the different policies and procedures, and also when it comes to risk management, how different risks are managed properly, what is the process, whether the system is in place, whether the reporting captures sufficient matrix. So all of these audit activities happens regularly within the organization, and we very often receive requests as a compliance function from the audit. Sometimes they would clarify with us on how certain risk was managed, or sometimes it's just a thorough review of certain practice within a non-financial risk management aspect. So yeah, this is just the 3 lines of defense and how that looks like in IFC's context. But coming back to your question, Bob, I think in terms of how big these units are, I would say Treasury, given the most important function to safeguard IFC's AAA rating. But that also requires certain expertise, because many of them come from the investment banks, especially on the trading floor, doing fixed income and derivatives. So that requires more of a financial and technical quantitative finance background, as opposed to, for example, environmental and social colleagues. Many of them carries more of a different background in environmental social aspects. Our function in business risk and compliance, or what we call non-financial risk, we have a lot of lawyers, but also compliance officers and people with other expertise like data, technology, those. So I would say it's hard to say which department or which unit has the highest headcount. They're equally important, but subject to the volume of the project and the level of engagement each function will need to be involved in a certain project. That also determines the size, the size of the group.
Okay, I see how you maintain your AAA rating, right? You have people on the ground, so they can see what's going on, and they have the expertise. You have a board member, someone from your group serve on the board of the company that you lend money to. Typically, buy 2 seats. because under Robert's law rules, one person would make a motion and someone has to second it before it can be put to a vote. You cannot do that with one representative, right? But having one representative is better than having no representative on the board. The fact that your leverage is not really that high as a financial institution. Usually not, but it is what keeps you going, right, with the funding and all of that. So just the risks that you have identified that IFC is most susceptible to, and are they always the same, or do you get variation?
We can certainly talk about that, but just to go back to our impact, I mean, we take minority positions, and picking up something that Andy said at the beginning, we try to bring in other capital and mobilize from other institutions to sort of give us more impact. And there are a lot of institutions that will take a lot of comfort from the fact that we're going into a deal. So we might be going in with a relatively small amount, but because of the level of due diligence that we do and the technical capacity building that we provide, a lot of other investors will sort of come in and get comfort and perhaps wouldn't if we weren't there. So I do think that we do have a lot of impact and punch above our weight. And actually, typically, we would just have one director on the board, although I do like the analogy that you make. We would typically only have one. Sometimes when we mobilize third-party monies from our internal asset management functions, we will have a second seat. But typically, it is just one.
It works.
Yeah, it does work. And that person on the board, owes their obligations to the company, but they can sort of talk about the additionality that IFC can provide. It's a really important value add, we think, to have somebody on the board.
So just to add on this board member aspect, and remember, very often these are early stage companies. So it could be a very small board, and with most of the board members being the founding members of the company. So it's not, I mean, many of the board meetings will not look like those formal board meetings in a listed company where people convene in a fancy boardroom, but it's relatively smaller board, and and many of the discussions will be very close to the operation of the company itself.
And also, I like your approach to the 3 lines of defense and the fact that the 3 lines are allowed to interact. The OCC, in October of 2020 issued a guidance precisely asking for financial institutions in the US to do just that. That the first line and the second line and third line should not be silos. They should be interactive.
I'd love to comment a little bit on that. I absolutely agree. I mean, that is the way we operate. So for example, we've got the third line, which is the internal audit. Now, in order for them to be effective, and they do have a very effective, in my view, 3-year program, they've got to kind of have a sense of where the risk areas are. Where can they add value? What should they be conducting an audit on? So they need to be, while they need to be independent, they also need to be privy to some of the discussions to sort of know what the business strategy is so that they can design their work program. So there's a lot of sort of overlap there. While they maintain their independence, they need to know what's going on. But another area where there isn't a silo is between the first and second lines, and particularly in areas where things are becoming very regulated and difficult. So we expect that the projects that we finance have good, tax governance, for example, and we expect if we're investing in a financial institution that they will have robust anti-money laundering, anti-terror financing controls. Now, they are very technical areas these days, and our first line often say, goodness, we're just not experts here. You're putting it all on us. We can't cover everything. So the second line, the line that Andy and I work in, often do more in those technical areas. We sometimes call it colloquially a 1.5 line. So in areas like tax, anti-money laundering, we find ourselves having to do a bigger lift. And particularly when it comes to disclosures to the board of the risks that we can't mitigate, it really is very demanding to expect a first-line investment professional to be an expert on transfer pricing, for example. So there is definitely a conscious decision that there shouldn't be siloing, picking up the advice that came a couple of years ago.
Okay, in terms of, we can jump into career opportunities.
Yeah, well, we can certainly do that. We were going to talk a little bit about the risks. I'm very conscious of time. We were going to talk a bit about these anti-money laundering risks and the types of risks that we deal with, that you asked about a moment ago. And maybe quickly you could run through some of them. I think they're quite interesting risks.
Sure. So very briefly, I mean, this integrity risk would mean the risk associated with these counterparts that IFC, either individual or entities that IFC may engage in, their profile, their background, their activities may have a material reputational impact and sometimes even financial impact on IFC. And just to give you an example, this would be if we engage with a company associated with a person that is on a sanctions list, or if this person is a rather controversial, politically exposed person, or IFCC investments, our investment vehicle was used as an instrument for tax evasion purposes. So all of these issues may come up, as part of an IFC project. And we, as the second line of defense, first we maintain the overall policies and procedures, these policy PMP framework to manage these risks. And then when it comes to a medium high risk issue, the first line, the business teams, the investment teams will come to us for consult our integrity risk officers for a more experts, second pair of eye opinion. And then if the risk material, if this is a relatively high risk and there's still a decision to pursue that deal, that project, this will need to go into an escalation process to the management committee. And sometimes this will also disclosed in the board paper, which is the formal document to be presented to the board when it comes to a board discussion. So coming back to the example of this Turkish bank that we are interested in investing, a risk associated with that could be if this is a financial institution, what is the bank's practice in managing money laundering issues, and whether this bank could be used by the criminal for money laundering purposes. So with that, on the risk identification, we would rely on different information, either through external vendors, for example, those sanctions list, or some of the information our investment team gathered from the grounds to make the determination what are the risk factors. And when it comes to the risk assessment steps, our investment officers will discuss this risk with our AML specialists or our integrity risk officers to see how to manage this risk. And very often this will trigger some more substantive discussion with the client to request more information, more clarification, some of the documentations. They have to make sure IFC is comfortable with the client's current practice and internal control in managing this risk. And when it comes to the mitigation, we might introduce an action plan requesting the client to have these and these control in place before or in a period after IFC conduct the investment. And lastly, when it comes to the risk monitoring, very often there's a periodic refresh for our teams to revisit the deal, to redo the due diligence to make sure these risks doesn't alter the client.
I just add very quickly to that. So that is if we were doing a deal in what we regard as a kind of a middle income emerging market. If we're doing it in a fragile country, on top of all of that, there's the challenge of, and let's think of a West African country, a Niger or DRC or Nepal or Laos, somewhere like that. We've got the challenge of there's not very much public source material to be researching. It's quite difficult to visit these countries because they're not very safe. There won't be robust company registers and things of that sort. There can be a lot of local language issues. That's why we want people in country, in our 100+ offices, to sort of help, particularly in those places where if you don't have boots on the ground, you will have no idea what's going on. So I think I would we'll stop there because I know you want to get to the next part of the discussion. But what we do, I think I wanted to make the point that we are doing deals in the Turkeys, the Chinas, the Indias, the Brazils, but we're also doing deals, usually much smaller deals and usually debt, because it's very hard to do an equity deal in these countries. But these countries in the Sahel and these much more fragile countries, often torn, ravaged by conflict.
But I know you have mentioned that the fragile segment, you have a higher tolerance risk there. But also the monies that you are not among the smaller.
Exactly.
Right, and first amount. So you may have more impact there from the number of deals you make, as small as they may be.
Exactly. I mean, the way we phrase it is it's very hard to find bankable deals in Somalia. So the deal will be smaller. It will typically not be equity. It will simply typically be a loan, and it will typically be combined with technical capacity building.
So you make most of the spread, I guess, with the middle income.
Absolutely.
That's not unusual for banks to manage their cash flow and.
Well, of course, a lot of banks are not in these markets, the really fragile ones. They've made a decision that it's not worth their while. But for us, our mandate is to be in these places.
Right.
So that's the difference.
Yes. Okay, so thank you for this wonderful explanation of what those multilateral banks are. I mean, they're banks, but they are special categories. They're intermediaries, but the parties that they connect are a bit different. So, potential career opportunities for young professionals, and not so young. Where are the opportunities in that space?
Well, I would say that there's a lot of opportunities. So, and I would also say, I said at the outset, I'm a lawyer. There are lawyers in these organizations, but I'd have to say there are many more other disciplines. And a lot of people think that these development banks would largely be economists, and there certainly are a lot of economists. But there's a lot of people, particularly in the ones that operate in the private sector, that have their MBAs and their masters in sort of business and finance. IFC, there'd be very few people in IFC that don't have private sector experience or a sort of private sector sort of mindset, even though we're owned by all the countries of the world, which makes us a bit of a sort of hybrid public-private kind of institution. But multiple disciplines, we hire at all stages in the, in the age spectrum, if you like, all levels of experience. It is competitive, I'd have to say. A lot of people are very drawn, and I might say particularly younger generation, they really like the idea of the mission and the mandate. And I know from having been in private practice myself before I came to the World Bank Group, a lot of the substantive work that I do is not so different from what I did in private practice, but the environment is completely different. To have the mission and the mandate and the multicultural mix. I mean, in our team of maybe 45 people, we've got about 27, 28 nationalities, and we speak very many languages, even though the group is really quite small. I might say I speak one language, but there's many people, particularly Africans, who speak large numbers of language. So I think it's an area that young people should give thought to. It's a great and unique work environment. Andy, you're living proof that you can join and have an interesting career, I think. You might want to talk about that.
Yes, and I would echo what Carrie just said. It's really an organization with very diverse background in terms of professional experience, culture, language, all of that. And I would also add that there are many avenues in order to, for example, if you there's a passion to work in MDB or working on development work. There are many avenues to start with these organizations. Obviously, the most obvious would be, to work as a staff of these organizations. But very often, these type of organizations would require certain years of level of working experiences in a relevant sector, even for junior job. So, but that remains as an option. And then second is there's very often this consulting or consultancy type of work that MDBs would require. And usually it's a contract-based work between you as an individual and the organization, but it wouldn't be counted towards the total kind of workforce. I mean, it's counted as the total towards the total workforce of the organization, but it not necessarily go into the headcount of the organization. And usually these contracts is quite flexible. And if you have a particular, let's say you have a particular interest in a certain area, just using environmental and social as an example, and there's a particular project that would require certain level of engagement from an expert with the right relevant skill set, that could be materialized as a consultancy service between this individual and the MDBs. And other avenues would be, for example, if you go and work for a Big Four company, and these Big Four companies may also be hired as a contractor to work on a World Bank project, and with that you also will obtain some insights of the organizations. And I also wanted to mention there are two major events that are hosted by the World Bank on an annual basis. One is a spring meeting. It's an annual event where World Bank would bring all the development community from all over the world to convene in Washington, D.C. I think sometimes in Washington, D.C., sometimes in a regional hub, and in DC usually is sometimes in April. And I think for academic, I mean, either students or students working on certain research projects, I think it's all eligible to participate. And I think that will be a very good opportunity for young professionals to kind of start in touch with the MDB community to see what are the discussions there, and what is the kind of the dynamic, and also to do some networking. I think that will be super helpful. And then the second event will be the annual meeting, which is the annual board of governor of the World Bank would be convening in DC, but there will be some side events, and many of them would be open to public. So I think these two would be also interesting kind of events for students to explore.
And also you mentioned financial type risks, right? You mentioned about credit risk,
yes,
about derivatives. So if you're on a financial track, then you might apply there as well.
Yes, indeed. I like that you mentioned Treasury. I mean, I worked in Treasury on the bank side, the World Bank side, for some years before I moved to the IFC, the private side. So there is a big Treasury function for World Bank and IFC, and every MDB has a big Treasury function. And there's the bond issuances for sure, but there's also a trading program because they do a lot of swaps and they do a lot of repo transactions and some pretty sophisticated Treasury activity going on.